I'm Ted Seides, and this is Capital Allocators. This show is an open exploration of the people and process behind capital allocation. Through conversations with leaders in the money game, we learn how these holders of the keys to the kingdom allocate their time and their capital. You can join our mailing list and access premium content at capitalallocators.com.
All opinions expressed by Ted and podcast guests are solely their own opinions and do not reflect the opinion of Capital Allocators or their firms. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of Capital Allocators or podcast guests may maintain positions in securities discussed on this podcast.
My guest on today's sponsored insight is Mo Haghbin, the head of multi-asset solutions at Invesco, where he develops and manages asset allocation strategies and portfolio solutions for $88 billion of client assets within the $1.7 trillion asset manager. Our conversation covers Mo's journey to finance and his path to a leadership role at Invesco. We discuss Invesco's solutions-based approach that canvasses every type of asset pool and structure and focuses first on top-down strategic asset allocation and tactical positioning, and only later on manager selection. We cover the research that drives asset allocation and factor decisions, importance of scaling customized solutions, and impact of technology in the process. Before we get going, Capital Allocators has entered the world of AI. We've trained a large language model on all our transcripts to help you learn anything you want from 7 years of conversations. We've affectionately called this model ChatGPT. It's safe to say Hank Morgan and I have no idea how to build an LLM, train data, and get the outputs that ChatGPT delivers. So a special thanks goes to our friends on the data science team at Atalaya Capital, who took on the development of the minimum viable product from start to finish. What they've done for us barely scratches the surface on how they're using AI to enhance their investment process, but I'll leave that to you to discuss with them. ChatGPT is the latest add-on to our premium membership. To sign up for a premium membership and access ChatGPT to query all our transcripts, go to capitalallocators.com. Thanks so much for spreading the word about ChatGPT. Please enjoy my conversation with Mo Haghbin. Mo, great to see you.
Thank you for having me.
Why don't you take me back to your upbringing?
Sure. So I have a very unusual path. I started out about 7,000 miles away from New York City in Shiraz, Iran. So my parents were a very, I would say, middle-class family in Iran. My dad was a college professor. My mom was an economist. And we started life in a very normal way, but things changed quickly. So we grew up during the revolution where the Shah had been essentially ousted and there was an Islamic revolution. So my parents very quickly decided with 3 young kids that they needed to change. And we moved to the US when I was in elementary school.
So what was that schooling path like from there?
We settled in Colorado, and I went to elementary school, middle school, high school, and actually college. I went to the University of Colorado Boulder, and I got a degree in finance. What's really interesting is my parents basically had to start all over. They couldn't carry forward those jobs that they had in Iran to the US. So my upbringing was very much unique in that we didn't have all of those structures in place for me and my brother and sister to really be successful. We had to learn a new process, learn a new system. So I put myself through school and learned along the way, I would say, because my parents weren't really there to give me that guidance because they were also learning what it was like to be an immigrant in the US. But yeah, so I graduated from the University of Colorado Boulder. I spent a few years in Colorado, and then I quickly moved to the West Coast and started my career in finance in San Francisco.
So those aspects of learning when you were a kid, as you reflect back, what were the things you didn't know that you felt like other kids did?
If we're talking about the financial services industry, so things like a 529 plan, a retirement account, FAFSA and filling out higher education, financial assistance, these are things that really were foreign concepts for someone coming to the US. So I had to learn those things. Also, the language barrier is actually a pretty big one. Learning English as a second language is much more challenging, I think, than you'd think. It's not just learning as a second language as a hobby, but you have to in order to be successful in a new country that you call home. But I look at those years as really foundational years for me because I think I learned a lot about how things can change quickly, how to be adaptive, how to be flexible. I learned a lot about saving and investing because it was necessary to be able to go to school. So it was a really great experience for me. I don't really regret that. I actually think it was something that made me much better at my job, helped me with school, because those challenges really formed a strong character.
What was it that drew you to finance?
So actually, I didn't really know what I wanted to do. I found a role at an RIA in San Francisco that honestly was something that was more luck than really intentional at that point. And I basically packed up all my stuff and moved to San Francisco. And that, I think, really was a time where my understanding of finance was quite different. I couldn't have told you what an investment banking job was like or what an asset management job was like. So that was my first experience. Quickly from there, I got a job at Barclays Bank, which was probably what really shaped my career from there. I decided that I wanted to be more on the institutional side. The RIA channel was very heavy on client-facing activity, which I enjoyed, but I was more analytical and I tended to be more interested on the investment side. So the Barclays job really helped me get some of that experience that helps me today with my current job.
As you roll forward from there to where you've come today, what were the formative lessons that shaped your path to Invesco?
So I've been lucky in that I've had a lot of experience across various asset classes and types of roles. So I mentioned the RIA in San Francisco. At Barclays, I was more on the derivative side, pre-financial crisis, which ended up being a really interesting job, a front row seat to some pretty interesting things. From there, BGI was acquired by BlackRock and I moved into fixed income. And I spent many years in fixed income, both on the long-only institutional side, but also on the exchange-traded side. And then more recently, equities. So what I would say about my career is it's been really diverse. Every couple of years, I've been afforded an opportunity to do something new, which I think is very helpful if you sit in a multi-asset seat, because you need a broad set of experiences and you're not investing in a single asset class. You're not picking securities, you're allocating capital. So you have to know a lot about a lot of things, but you don't need to know everything about a certain thing.
What were those different roles that you played in each of those asset classes?
So on the derivative side, I was supporting our hedge fund business. So BGI had a very large systematic hedge fund group, and I was supporting a lot of their exotic transactions. Credit default swaps, total return swaps, inflation swaps, interest rate swaps. At the time, all of that was bespokely negotiated. Pre-financial crisis, there wasn't any standard mechanism to trade those things. So you'd get a document that was like 100 pages long that you'd have to review in order to get confirmation with the counterparty that you actually had a trade. So that was the experience originally. Fixed income, very focused on credit and multi-sector. So the long-only systematic group at BGI was really, really successful thinking about index-based concepts. So everything was methodologically driven, fully transparent, which was actually really interesting because I ended up moving into the ETF business, into the iShares group, and I spent many years working with index-based fixed income solutions. More recently, on the equity side, applying some of those systematic approaches that I've learned in the past, but to a set of new asset classes. So within equities and more recently thinking about public-private and multi-asset investing.
So you arrive at Invesco. What is the lump sum of Invesco today?
So Invesco manages about 1.7 trillion in assets for clients globally. Within the solutions group, we manage about 88 billion of assets. And that's pretty diverse across client type. We work with financial advisors, pension funds, endowments, foundations, insurance companies, sovereign wealth funds. So it's pretty diverse, both from a client segmentation as well as a geography perspective.
So you use the magic word solutions, which means a lot of things to a lot of different people. How do you define what the solutions group is?
So I think it starts with really working backwards from the client. So within asset management, within our industry, we tend to think about things as products. We build a product and we sell a product. Solutions starts the exact opposite way. We have a conversation and then we map to a capability or make a capability, create a capability. So really it involves a lot of dialogue, understanding not just a particular asset class or a particular strategy, but understanding a particular problem for a client, and then working with our broader capabilities across the firm and sometimes even outside the firm to create the solution. So solution to a problem rather than product for a problem.
When you think about the scale of $85-90 billion, sometimes you think of the solution as this little niche gap in a portfolio, but at that scale, you're probably doing a lot of different things. So as you look across your business, how do you think about serving different clients and different solutions you're creating for them?
It really depends. We have certain clients that are very fixed income heavy. So think about a pension fund that's in surplus. They're not really worried about generating additional returns. They're worried about immunizing or matching the cash flows or future liabilities. Take the other side of that. If you have an underfunded pension, well, they are looking for growth. They need to look for opportunities to get closer to their funding ratio. With sovereign wealth funds or other perpetual organizations, they tend to have really long horizons. So intra-period or annual volatility is not as big of a concern. They can take a lot more risk and they're not worried about mark-to-market as much as other types of clients. Financial advisors have to manage relationships with their end clients. Their end clients could be very risk averse. We have to build a solution that meets those needs. Because we work with such a diverse set of clients, it really just depends on what the objectives are. We're generally benchmark aware, but I think what people don't understand is that understanding what that benchmark is really important and really hard sometimes. What is the goal? What's the objective? From there, we can apply our asset allocation techniques and try to deliver a performance result that's better than the benchmark, but it starts with the benchmark.
So you have this widely dispersed range of needs, and you're trying to create that benchmark and execute. What sort of overriding investment philosophy do you bring to serve these clients?
So the team is very much a top-down asset allocation team, and we think about asset allocation in a regime-based framework. So business cycle aware framework. Everything we do is geared towards understanding long-term return drivers, so strategic asset allocation decisions, and shorter-term return drivers. So think 6 months to 3 years, tactical asset allocation decisions. From there, it's really about how we implement, and we generally implement through managers. So we're selecting a manager within public equities to get the exposure that we're looking for in equities. We are selecting a manager in private credit to get exposure to direct lending or distressed credit. We're not directly investing in those markets. So that's the last piece of it, is the portfolio construction and manager selection piece, which becomes really, really important because it's bringing the puzzle pieces together. It's a little bit art and science. You can't perfectly do that through your regular analytics reports and reports that you get from the systems. You have to really think about both the quantitative and qualitative aspects of what makes a manager successful and how that manager behaves with other managers in the portfolio.
I'd love to dive into the implementation of that in those three pieces, say the strategic, tactical, and the manager selection. What inputs do you bring in that strategic asset allocation to form macro views that will help you understand where you want to invest tactically and with managers?
Yeah, so great question. For strategic asset allocation, historically, what many firms have done and what we also do is think about capital market assumptions. So we're looking at essentially estimated risk and return for asset classes over a 10-year horizon. The problem with that is it's really hard to estimate what returns are to be expected from equities 10 years from now or what risk should be expected. So we take that approach and combine it with things that I think are a little bit easier to predict. What we're trying to understand is, historically speaking, what structural long-term bets have been rewarded. I'll give you an example. Value. Valuation is something that over the long term we see has been rewarded. That doesn't mean that over 3 or 5 or 7 or 10-year periods, it's going to be rewarded. And we've seen that. We've experienced that in the more recent times. But we think that's a long-term structural bet. So it's this combination of our expectations around asset class returns with what we have historically seen rewarded in market. What structural factors, whether they're behavioral or risk-based, have been rewarded by the market.
So if you take equity as an example, you mentioned valuation, you could think of the basic factor assessment, quality, size. What are the levers that you like to pull in just say your equities portfolio?
This is where we have spent a lot of time over the last few years, taking asset allocation frameworks and applying them within an asset class. So you mentioned equities. We, like everyone else, noticed that it was increasingly difficult to add value, to drive alpha within parts of the equity portfolio. So think large cap US equities, very difficult to add excess returns. And we had a problem. We had a very large part of the portfolio allocated there. It's actually the largest for most clients, but it was harder to generate returns beyond the broad-based indices. And we developed something that I think is quite innovative. We started out thinking about asset allocation decisions. We use a regime-based framework, so we understand economic growth and changes in economic growth and the sensitivity of asset classes to those changes. So what are cyclical assets or what are counter-cyclical assets? And then we said, okay, what if we just took that same framework and applied it within equities? Are there factors or sectors that also behave that way? And what we found is the answer is yes. So things like size and value tend to be more pro-cyclical. Things like quality and low volatility tend to be counter-cyclical. They're more defensive. And are we able to actually systematically harvest those style preferences using a business cycle framework? And in 2017, we partnered with FTSE Russell. We created a suite of indices, and we started allocating based on historically rewarded factors during stages of a business cycle. So think recovery, expansion, slowdowns, and contractions. How should we overweight or underweight factors to get potentially the best possible outcome in the shorter period? We know over the long term, structurally allocating to factors are rewarded. But most CIOs, most people sitting in portfolio management seats don't have 20 years. They have to also generate returns over 3, 5, 7, and 10-year horizons to keep their jobs. So we felt like it was very important to think about equities a slightly different way. And we use the products within our own portfolio.
There's this marriage that you're describing between strategic asset allocation and tactical allocation. So on the strategic side, let's just say value works. If you have a 25-year horizon, nobody has a 25-year horizon, you better figure out what to do in the middle. How do you bring those together to figure out where you are in a regime?
If you think about factor investing, the starting point is be overweight all factors equally because their excess returns are negatively correlated, and over time, you will get the benefit of diversification. We agree with that. There's nothing wrong with that approach. But we also understand that over shorter horizons, taking views on factors, taking views on certain styles can be beneficial. So if your benchmark is the broad market cap, your long-term position is a overweight to certain rewarded factors. Your tactical position is how do you adjust that overweight given what's happening in the market today? How should I tilt my portfolio away from both my benchmark and a neutral overweight factor portfolio to harvest potentially excess returns over a shorter horizon?
If you look at equities today, how are you thinking about the next few years?
So our models generally tend to change 2 to 3 times a year. So they are pretty dynamic. I would call them low frequency quantitative strategies. If I look at our current positioning, tends to be a bit more pro-cyclical. We tend to favor smaller and middle capitalization companies, value-oriented companies, because what we're seeing from the economy is actually quite impressive. It's been very resilient. Most people expected a recession by now. We haven't had a recession. Employment is very stable. The consumer is pretty healthy. Generally speaking, in periods of economic expansion and recovery, factors and sectors that have higher operating leverage and more beta to the market tend to outperform. So that's how we're positioned. But we can review that on a monthly basis. So if something changes, we reserve the right to also change. So it's a little bit more of a dynamic approach to thinking about it. And what I find quite interesting, we used to do asset allocation studies for clients every 2 to 3 years. Now imagine if you haven't done an asset allocation study for 2 to 3 years. Interest rates have moved from 0 to 5.5%. The world is completely different. And if you haven't changed your asset allocation, you're probably missing something. I believe that given the importance of equities within the portfolio, and alternatives and other strategies have been very popular, but equities is still the largest allocation in the portfolio. Thinking about that allocation in a more dynamic fashion, given the speed at which things change, is becoming more important.
So that set of decision factors of what's happening in the economy that's leading you to be pro-cyclical, there are other people that might look at it and say, well, the same set of factors would tell me to be contrarian. The market thinks rates are coming down. That's good. Well, maybe now's the time to be more cautious. How do you get from looking at the set of factors to making the decision about where you want to bring your client portfolios?
The way we're talking about this is very conversational, very casual. It's much harder than the way we're having this conversation. We take all the emotion out of it. That's the first step. We aren't waking up every day and saying, how do we feel about the market? We build models. So we have a model for a leading economic indicator, basically trying to understand through the data whether the economy is growing above or below its long-term trend. We also have a model for risk appetite. This basically measures in aggregate what capital market participants are experiencing as they move out on the risk curve. Those two models combined tell us a little bit about how we should position across the factor set. So if leading economic indicators suggest that the economy is growing above its long-term trend and risk appetite is accelerating, that's a pretty healthy environment for risk assets. That's an expansionary environment, and we're going to favor small and mid-cap stocks and maybe momentum because there's a clear trend with growth. Conversely, if our leading economic indicators are showing that growth is below trend and decelerating, that's generally a sign of a contraction. So we would then get more defensive in the portfolio. We would upweight higher quality, larger companies, lower volatility companies. All of that is systematically done. There is no discretion per se. The discretion is how we build the models, how we think about the world. But then as we implement the portfolio, we try to remove the emotion. We try to remove the day-to-day biases. We are all subjected to a lot of information. You wake up in the morning and the news flow dominates your day. We don't want that creeping into the portfolio.
So if you look at this 2x2 matrix effectively of where you are on risk appetite and the strength of the economy, you mentioned positive, and negative. How do you think about the other two? So economy strengthening, but risk appetite's decreasing, or economy softening, risk appetite is increasing?
In that 2x2, you're talking about recoveries and slowdowns. So slowdown is where growth is above its historical average, but the market is telling us that sentiment is shifting. So in those periods, we would still be a bit more defensive. Where we would introduce momentum is really at those cyclical peaks and troughs. So what I mean by that is we generally wouldn't want to be in momentum when there's a sharp reversal. It tends to have really bad reversals. So those factor exposures are actually preset. We're not sitting around debating whether or not we like size or value today. They're preset based on where we are across those four regimes.
So if we move past equities, let's turn to fixed income. How do you apply this tactical asset allocation lens in the fixed income market?
With fixed income, the factors that drive the majority of the returns are different. So you can explain most of the return in fixed income looking at interest rate sensitivity and credit exposure. If you have international, then FX would also be in there. But the same applies when we think about allocating capital to fixed income. What is the duration profile of our benchmark? Where are we relative to that? What is the credit risk of the benchmark? Where are we relative to that? So it's all relative to benchmark. And if we are more defensive, then we might be adding interest rate risk or adding the sensitivity to duration. So getting longer duration. If we are more optimistic, we might be increasing the credit risk of the portfolio.
Similarly, in fixed income, how do you think about changing your duration or turnover of changing the posturing of the portfolio?
So it depends on how we would implement. In a lot of our allocation products, what we like to do is not move the managers. So remember, we are not picking securities, we're picking managers. And changing managers can be actually quite cumbersome. It could actually lead, if it's a taxable account, to a tax event. So we try to take that tactical view and overlay space when possible. So think about adding duration using treasury futures. Think about adding credit or subtracting credit risk using CDX.
Now, in equities and fixed income, the levers are reasonably known in terms of the drivers of return. You get into some of the alternative categories. Some of it is a little harder to put your finger on what's going to move the needle. So how do you think about that structure, applying it to alternatives?
I think the challenge in alternatives is that you actually can't really be that dynamic. You can talk about the marginal dollar, but the invested capital tends to be long-term. When we think about assets on the alt side, it tends to be more about where we want exposure for the strategic time horizon rather than the tactical time horizon, unless we have new capital to put to work, in which case then we try to understand where we are in the business cycle. So there may be certain asset classes that tend to perform better in early stages of an upswing and certain asset classes that tend to perform better in the early stages of a downswing or in a prolonged contractionary environment. There, I think the liquidity is going to be the key factor. Are you able to raise cash or move between asset classes or not? The answer is generally not. So we tend to keep that portion of the portfolio fairly static.
As you look at return composition, what have you found are the biggest drivers?
So I think as an industry, we spend a lot of time thinking about the bottoms up piece, idiosyncratic piece, but the majority of your return comes from your top down asset allocation decisions. So think about really simply, if you're underweight equities over a prolonged period of time, irrespective of how you sourced that equity exposure, you're probably going to be underperforming your benchmark. If your benchmark is 60-40 and you have a structural underweight of 10% over a 20-year horizon, you have to do a really amazing job picking managers and thinking about style exposures. Very difficult to overcome the fact that you're underweight equity risk. So the majority of the returns are going to come from your asset allocation decision. I would argue an equal, maybe not exactly equal, but pretty close, is going to come from your style decisions. And the rest is going to come from idiosyncratic. But we spend all of our time talking about that piece, which I find really fascinating.
What have you found about the predictability of the asset allocation and the tactical decisions compared to the manager selection decisions?
So the evidence around factor returns and their cyclical behavior is pretty strong. We've seen over 7 business cycles that factors tend to behave a certain way. And it's not just because we've looked at the time series and looked at the performance. There's a really good reason if you think about the fundamentals of those factors themselves. Smaller companies tend to be levered. They tend to have less cash flow and they source a lot of their cash flows with external funding. Larger companies, higher quality companies, they tend to be really profitable. They have high return on assets. They source a lot of their cash flow from internally generated activities. They don't rely on debt. So it's really intuitive almost, where you say, well, if we go through a recessionary period, the company that has a strong balance sheet, internally sourced cash flows, very little reliance on debt, is probably going to weather that storm better than a company that is going to look to the capital markets for help or doesn't have as much profitability to weather that storm or cushion that storm. So that's been very, very strong. On the manager selection side, it's harder. It's really hard. I think you can use quantitative and qualitative ways to understand manager performance, but in a lot of asset classes, things will surprise you. The best managers will end up being the worst managers. And sometimes you have to almost be a little bit of a contrarian on that. You want to allocate capital maybe at times where managers are struggling rather than delivering really, really good returns. So I would say the hardest part is the manager selection part. I would say our asset allocation decisions, we tend to feel really comfortable with and we understand really well. Our factor exposures, we tend to understand quite well. Managers, it's just tough. It's really, really tough. So I think people that are in that space and spending time on the qualitative pieces really have an interesting job to getting to know the person or the team behind a strategy.
So you're ultimately filling your portfolio with managers, and you have this interesting seat where Invesco's managing close to $2 trillion, a lot of those managers, then you've got a much bigger world outside. How do you think about using the internal Invesco managers compared to an open source platform with managers outside Invesco?
So we've always been, and I think we were early, open architecture. We just fundamentally believe that investors are looking for best in class across every one of those portfolio allocations. So we put Invesco through the same process that we would put any other manager. And if we end up being the best manager in that space, then we are deserving of that allocation. It's important because the solutions group is somewhat distinct and objective part of Invesco. We're not really sitting within an investment team or focused on, again, building bottoms up portfolios. We are solely responsible for those allocation decisions. And many clients really challenge us there. So think about model portfolios where we're delivering models to financial advisors. They want to understand why you made all those decisions. They want to understand why equal weight 500 for US equities, why Invesco Core Plus for fixed income. So we have to use the same manager selection process. There's no difference between how we think about the scoring of a manager, whether they're within Invesco or sitting outside of Invesco.
When you have that comfort in the process on the strategic asset allocation, tactical allocation, manager selection, how do you think about active versus passive and just not filling those portfolios with either an index or a simple factor that gets you where you want to be?
So we have an incredible team. Many of the things that we're talking about are not possible without some of the people that we've hired. So Jeff Bennett on the team, who leads manager selection research, and the analysts that support him are tasked with really understanding where it makes sense to source that exposure using lower cost passive exposures and where it actually makes sense by an active manager. The answer is not always passive always for here and active always here. It depends. And I also think it's not just passive versus active, but vehicle choice. When does it make sense to use exchange traded funds versus mutual funds versus private vehicles? These are all decisions that the team is making based on what we understand the client's needs are. A lot of it is driven by what we hear from the client and their preferences. Sometimes they actually have preferences around managers that we then have to incorporate into the portfolio.
When you have this breadth of client types and you've got these different levers of strategic tactical manager selection, how do you go about organizing the team so that you can deliver these solutions to your clients?
So it's important to have an investment process that is well-defined and repeatable, and I would argue modular, so that you can actually bring pieces of it together to meet those customization needs. If you don't have that, then to your point, there's infinite combinations and there's so many different variations, which makes it less likely to scale. And we are in the business of trying to scale this capability. So what we've done is created a process where tactical asset allocation is really a risk budgeting process. It's really a way for us to think about short-term deviations from a strategic allocation that then can apply to many, many accounts underneath based on their underlying constraints. So think about a world where we have a representative account, the representative strategic asset allocation, the representative tactical asset allocation. And then what we do is we apply that across accounts that might have restrictions or compliance deviations. So we have an investment group or a portfolio team that focuses on tactical asset allocation. We have a strategic asset allocation team and a manager research team. And then we also have a research and analytics team. So Nick Savalides, based out of Boston, leads a team that really isn't thinking about necessarily asset allocation decisions in real time, but doing research around our methods and our processes to help us better understand changes we may want to make in the future. They're also responsible for the underlying technology that we use, both to engage with the client, but also to manage the portfolios, which I would not discount. That is such an important part of what we do. We talk a lot about the investment part, The less sexy part of it is the operations and the technology part, but without that, it would be impossible for us to really do what we do.
What if you learned, both your experience in Invesco and previously, about what works in this approach and, importantly, what doesn't?
Well, so if we're lucky, we're right 55% of the time. We're probably wrong a lot, and we have to get comfortable with being wrong a lot. What I mentioned earlier around repeatable process and making sure that it's articulated, that allows you to then stick with something, even though maybe it's not working in the short term. Because again, there's going to be times where it doesn't work. Think about, for example, our dynamic factor strategies. We have a period of underperformance. Now, do we go and change the process? No, we don't, because we're highly convicted in the process. That's the first step to a death spiral, is if you keep tweaking and moving back and forth based on current market conditions. So I think one of the things I learned early in my career, and I still believe it, is systematic or investment processes that are well articulated and repeatable tend to have a better effect on short-term behavioral biases.
When you're facing all of these different types of clients, I'd love to ask you about different trends you're seeing, maybe both on the investing side and the delivery of these solutions.
Sure. So within equities, I think one of the things that is really interesting, and part of the reason we went down this path of creating the dynamic strategies, is for a long time, the trend was, there's no alpha here, so let me just index it. Lowest cost possible. And it's really convenient. It makes life a lot easier. There's zero risk of getting fired. Match the benchmark. I think what we're seeing, especially on the institutional side, is a desire to rethink that, is a desire to be cost conscious, absolutely, but not necessarily give up all expectations of excess return. So equities, I think, are going through a little bit of a revival. They're going through a little bit of a renaissance where clients are starting to rethink that allocation. They're willing to take risk there again. And for a long time, I had not seen that. I'd seen basically a cost mitigation exercise. On the fixed income side, a lot has changed, with yields being the most attractive we've seen in a very long time. So a lot of clients are thinking about how to deploy cash back into the market. We still have a significant amount of cash, by the way, on the sidelines. If you look at bank deposits at 17 trillion, money market funds at 7 trillion. So there's 25 trillion of assets that are sitting in cash. That's almost 15, 20% of all US wealth sitting in cash. I think there's a huge opportunity for us to think about putting that back to work, and the yields on offer in fixed income are very attractive. So a lot of our conversations with clients are how to actually extend duration, lock in those yields, and really rethink the fixed income allocation. And then on the private market side, we've seen quite a bit of interest in credit strategies, real estate strategies, the combination of those things as well. And I think that's a big opportunity, especially within the wealth channel. How do you fill out a private markets allocation for an advisor? It's a really difficult and complex thing to do if you don't have the staff. So for a solutions group like ours, we can be the extension of staff. We can help optimize that allocation and deliver something that gets you to your target benchmark or target policy level without all of the complexity of trying to manage the capital calls and the realizations and the paperwork that comes along with that.
If you pull the thread on those private assets in that RIA channel, there's a belief that there's tons of money coming. And then you see some of the larger firms building products that have a different liquidity profile than the institutional 10-year life fund with a series of infinite options of additional years after that. What are you seeing in terms of the appetite from some of your clients that want to engage in the private markets that haven't been there relative to the types of products that are offered today?
It's a fascinating time. We're seeing a lot of innovation in that space. We are finding ways to provide some liquidity. So think about interval fund structures, where you usually have a 5% quarterly redemption with a gate. I think these are really interesting structures, but I also think we have to be really, really honest about the fact that you are giving something up. To harvest the illiquidity premium, you have to take on the illiquidity risk. There is no free lunch. So these products, I think, are great. They will give you substantially similar exposures, but that liquidity profile is going to lead to slightly different performance outcomes than a long-term allocation to any of those asset classes.
What have you found special about doing this work inside Invesco compared to the various places you've been before?
I've been really fortunate to be given an opportunity within Invesco to lead the solutions group. I find Invesco to be a little bit in the middle between what I've experienced in the past. So if you think about BGI was a really academic institution, really smart, really, really focused people, flat organization. I think culturally, we tend to be thoughtful. We tend to think about the ramifications of what we're doing, both for clients, for shareholders, and our team members. But we also tend to be a bit more action-oriented. We're not going to sit around and debate that for the next 5 years. So I actually find it to be really, really exciting to work here, and the people have been fantastic.
What have you found about doing this work inside a public company structure?
So that's interesting because Oppenheimer Funds was private. So I've had both experiences. So I was at a bank-owned asset manager. That's a little bit different. Publicly traded asset manager, private asset manager, and then back to publicly traded asset manager. There are going to be slight differences. Obviously, publicly traded, you have more frequent touch points around stock performance and revenue and AUM. But I think it's all about the culture. A publicly traded company can still have long-term orientation. It's about the people that work here. Sometimes I think the market confuses publicly traded means very short-term decision-making. That's about the people that run the company. You can get the best of both worlds. It doesn't matter whether it's public or private.
From your perch today, in all your conversations with your clients, where do you see the interesting parts of where the business is headed over the next couple of years?
So I think the biggest trend around solutions is how do we offer a customization to lower account sizes? So this whole customization at scale topic, technology is going to be a big part of that. To your point, how do you manage delivering strategic and tactical asset allocation and manager selection to thousands of individual clients or thousands of smaller accounts? It's technology. So we have to invest there and we have to get better at delivering this value proposition for smaller client sizes.
All right, Mo, before I let you go, I want to make sure I get a chance to ask you a couple closing questions. What is your favorite hobby or activity outside of work and family?
Favorite hobby. So I like to travel. And when I travel, I like to be outdoors. So I get back to Colorado probably 4 times a year. And I sit on the business school board. When I go out there, I like to do a little bit of fishing, a little bit of hiking, Chautauqua or the foothills. And that's been one of the things I've always enjoyed. As a kid, I grew up camping. We'd rent an RV and we'd travel the country. So I have this emotional connection to the outdoors because I grew up in Colorado. I grew up very close to nature. A little bit different now that I sit in New York City, the concrete jungle, but I find ways to get out and still do some of those things.
What's one fact that most people don't know about you?
Well, I have a son that's neurodivergent, and it's actually been probably one of the things that has taught me the most about life and about challenging situations and working collaboratively with people that might not necessarily think the same way or act the same way. He's been actually one of my best teachers. A lot of long nights of understanding how to interact with him. And it's been very rewarding. And I've actually spent a lot of time thinking about how to bring some of that neurodivergent thinking into the workforce, because I actually think it's missing. I think there's an opportunity for us to really expand the way we think about those skill sets. And especially in something like investing, it could be super helpful to have different viewpoints.
What's your biggest pet peeve?
I would say my biggest pet peeve is parents that apply a lot of pressure to their kids. And I see a lot of this in New York City. You got to get into the Ivy League elementary school. If you don't get into that, you're not going to get into the middle school and the high school. I think we have to be a little bit more tolerant of different paths. I think about my path. I didn't have a really traditional path into finance. There's other ways to get there. And I feel like we've overdone it a bit with the pressure that we put on young people these days.
Which 2 people have had the biggest impact on your professional life?
So I had a manager early in my career at BGI who really took a chance on me. I mean, don't think I should have gotten that job, to be honest with you. I mean, he saw something in me that I don't think I even knew at the time. And all along the way, he invested a lot of time and capital into making sure that I would be successful. Gave me my first opportunity to lead a team when the acquisition was happening by BlackRock, made sure that I found a home on the other side. So it was very, very influential and impactful. More recently, Sharon French, who hired me at Oppenheimer Funds, gave me an opportunity to join the team and actually launch the strategies that we were just talking about. Giving me the opportunity to do something innovative and unique at a time where the firm was going through some transitions. So Oppenheimer Funds was an active, high conviction, international equity focused franchise. I was the guy from BlackRock trying to launch ETFs. So I give her a lot of credit for seeing an opportunity and giving me the space to actually create something new.
All right, Mo, last one. What's the best advice you've ever received?
So early in my career, I had a manager that was really thoughtful about how he built the team. And he always said to me, surround yourself by people that are really smart or smarter than you, and try to work yourself out of a job. And I thought that was so interesting because when you're younger, you're like, no, I need this job. I have to pay my rent and I've got all this other stuff going on. And it was really actually quite profound because his point was, you don't have to be the smartest person in the room. You can find people that understand a topic or a subject matter better than you. If you bring all of those people together, you can harvest that collective knowledge. You can create this environment where people are learning through osmosis. And the whole work yourself out of a job was more about, if you do a good job to the point where others now have learned a lot and could do the job as good as you, it's time for you to move on. And if you work at good organizations, they'll find you the next job. So I thought that was actually quite profound.
Mo, thanks so much for taking the time to share this really interesting approach you're taking here at Invesco.
Thank you.
Thanks for listening to this Sponsored Insight. Sponsored episodes are paid opportunities for another 12 managers a year to appear on the podcast. If you're interested in telling your story in front of the largest audience of investors in the industry, please email us at team@capitalallocators.com to apply for one of the slots.